First and foremost, welcome to the first Investor Power Hour of the year and the one of January, of course. For this Investor Power Hour, we are going to kick things off by basically doing a recap of 2025, kind of what went down, how it went, our thoughts on it, and as well as what we expect and what we see going forward as we move into 2026 and the year kind of progresses. So, with that, we have on the call myself, of course, Tarek Moussa, as well as my colleague in Investor Relations, Chris Ingle, and then, of course, the partners of the firm, Feras Moussa and Ben Suttles. And we'll go through this and kind of answer a couple questions that we have. And throughout this presentation, any questions that you may have as part of the audience, please click on the Q&A section of the Zoom window and enter your questions there, and we'll be sure to address them. So, with that, everybody, welcome to the call, and let's get things rolling. So, first and foremost, let's jump into the recap of 2025. So, to get things started, Ben, Ferris, team, let's talk about maybe what were the biggest achievements that you would say for Disrupt Equity in 2025?
Yeah, I mean, I think, and Ferris might have a different, answer to this question, but I think it's getting better clarity on where the market sits, where the market's going to be going over the next couple of years. I felt like we finally, some of the fog of interest rates and inflation has kind of dissipated over the last 12 months. New administration came in, which also kind of helps at least give a little bit of clarity on which direction they're going to go. The big beautiful bill came back, gave us 100% bonus depreciation, which is another huge benefit of investing in commercial real estate, which we liked. But I think that it also allowed us, at least here internally, to reinforce the foundation of our operation team on the property management, asset management, construction management side. I think, there was definitely some further foundation building that needed to happen. And I think us taking a step back from acquisitions over the last couple of years has allowed us to, to further solidify that foundation and bring in some really, really good team members, on that side of the fence to allow us to grow. So I think really 26, 27, 28 are going to be probably the best years of this decade to be buying. And so good to kind of get them in and get them kind of putting their stamp on how we do things and what deals we look at and how we operate those deals, I think was another big win for 2025. But it still has its headwinds, right? I mean, there's deals that, we want to be further along, in their journey. And the rent growth just really hasn't been there. So we haven't been able to do some of our unit upgrade programs and some of the other stuff that really pushes the needle. But again, it allowed us to kind of dial in what is the next few years going to look like with the right team and be able to kind of establish what those new plans are going to be. So I don't
Yeah,
know, Ferris,
no,
anything
and
you want to
I
add?
totally agree. I think the biggest thing for us as a firm, right? I think this week we turn, is it 8 or 9 years old this week? And, really the big thing that kind of happened over the past year is just continuing to get strong team members to join the company, right? We all know operations is where rubber hits the road. I mean, it's easy to buy deals, it's hard to operate them. And that's where, we've been investing in our management company for what, coming up on 5, 6 years now, right? And this is the year that we've really been able to elevate, find some really great hires, and continue to bring in strong people to help accomplish the goals that we need for us and our investors. And so, I mean, Disrupt's about 200 people now, and getting some of the best people we can find out there. And that was really to Ben's point. I mean, it's one of those years where it's not about a lot of growth. It's about actually setting up for the next phase, right? So how do we get strong people? How do we continue to perform? How do we kind of reinvent some of what we've had, and how do we think about it differently, right, to help us better achieve our goals and continue to just maintain kind of the quality and service that we want? And so it's been one of those years, and I kind of echo Ben's sentiment. I think, the next 3 years should be, hopefully strong growth years, right? As we come into kind of once we get through this year, really, right, starting to get rent growth, which then leads to revenue growth, which leads to real profit growth and distributions, as well as just deals starting to cycle. So.
Yeah, and I agree with everything you all just said. The other thing I do want to touch on is I think we deepened a lot of the relationships that we already had. We went out and had dinner with investors and went out and talked with them, got their opinion on deals that maybe are challenging, and got their perspective. So I do think just the deepening of relationships has helped us grow a lot as well.
Great.
Yeah, and the one thing I'd mention, yeah, I mean, we'd all want some of these deals to be further along. I think the one thing that we try to do is that continuous communication, right? Whether it's with Chris and Tarek and their teams, the monthly investor updates that we send out, right? Full financial packages. But we went a step further, and we're going to continue to do this. In fact, we're going to double down on this in 2026, where we're doing these dinners. We're getting in front of our current investors, not just new investors. It's not all about the next new deal, right? Because I'm a big proponent now. And they'll reinvest once the market starts getting a little bit better and they can recycle some of their capital. So we're going to continue to do that. To not only reestablish but also just solidify those relationships too moving forward. But we started that in 2025, and I'm excited to continue to do that in 2026.
Great. And just maybe additional data points for 2025. We did get some deals done. We got two deals done at a time when almost nobody else out there really did. Very few people, that is. We were also, of course, able to kind of do some work on some loans and try to improve some deals and refis. And of course, the some tax abatement kind of efforts along the way that are still being played out in legislation and so on. So we're able to get stuff done actually at a time when a lot of the market really has been fairly stagnant. So moving on to the next question is, what challenges or unexpected obstacles did we face last year, and how were they addressed, and what lessons were learned?
Yeah, I'll go ahead and take that one. I think one
Yeah,
of the things that we spent a lot of energy on
um,
last year was we saw that there was this HFC program going around, right, which is really an opportunity to better improve existing assets, right, and drive, additional NOI growth and value because taxes would basically be valued a lot lower. Right. So as a firm, I mean, we spent a lot of time and energy on it across multiple disciplines, multiple facets to really try to, go for that asymmetric bet for our existing assets and our investors. And so I think a lot of energy, time, energy, and money was spent on it. And for those that know about HFC, unfortunately, right, the legislation kind of passed, really not allowing what we expected, right? It's kind of a watered down version of what we hoped for. And so really a lot of that energy ended up kind of getting spent, but really not going to the value that we wanted from it. And so I'd call that one of the biggest challenges because again, I mean, it was, we had 5 to 10 people actively working through many, many different aspects of it. And so I'd probably call that one of the things that we spent a lot of energy on just did not really get the juice that we were expecting to squeeze.
yeah, and I'd also affirm that there's a pack of deals that we've been working on for any of our investors that are on the phone call, right? That we've been trying to modify the loan, get that debt service down, bring more capital to the table so we can kind of right size these deals. And I think over the last, not it wasn't even just 2025, it was really 2024 and even a part of 2023, we've been doing that. And some of that led to these refinances that we did. And some of these led to extensions and very favorable modifications that we did with our lender that were big challenges, a lot of time and effort and energy. I lost the remaining bits of my hair doing this stuff, and some of them are still being fine tuned and finished up in Q1. But that allows what we've learned from that is that lending relationships matter. Right. And I'm not saying that we're out of the woods on some of these deals. I think there's still a lot of work to be had, but those types of modifications do not get doled out to everybody. And so I think for those that are listening, right, establishing good relationships with your lender, communicating with them just as much as you communicate with your equity partners, and really trying to get ahead of problems is really where you're going to be most successful in this business because it is cyclical, right? It's just the top of the market, so things kind of go down, and now we're kind of now where we see is we're right here. We're about ready to start going back the other way, and so right here is where you need to have good relationships. And so that's where I've learned that those things matter and understanding what your loan agreement says because that's what the lenders are going to try to stick you with. And so understanding that up front, making sure you have a good relationship with the people that are giving you money, not just your equity partners, but all the last 18 months. And I think that plus the HFC were really the biggest challenges, not really obstacles, but things that we needed to solve for. That was a lot of work, a lot of stress, and but luckily we had some great partners that came alongside us, and our equity partners were there with us as well. And so I think we learned a lot. You learn more from those challenges than you learn from the successes in this business. That's just what it is. This business that you can imagine. I am humble enough to, right? And so I always learn from everything that we've done, and we fine tune and we get better every time we have those challenges.
Yeah, and I'll say the biggest challenge that I have faced in what I do is just the overall market sentiment. I have a lot of conversations with investors, and they see headlines about different groups that maybe have lost deals and whatnot, and you have to have a candid conversation about that and why it's an opportunity to invest in a deal. We're not getting in deals at the peak of the market pricing. So that's a great opportunity to pick up deals at a 25 or 30% discount. And I always reference people that bought properties in 2010, post GFC. A lot of them are very happy with the purchases that they made. So there was a lot of education with investors, and it's very challenging just given a lot of the headlines that are out there.
Yep. I think just let me summarize that. I think obviously there's the HFC matter, and I think we all knew that the loophole would someday close. I think that's not a surprise, but the question or the thing that we weren't anticipating was just how hard the Texas legislature was going to come down on that, and that they were going to apply retroactively. And obviously that is just an unforeseen event, and really there is no precedent for it. So that is why it is still ongoing through legislation. And maybe over time we'll actually see that turn around and be very favorable, but it's going to take time for that to play out. And of course, on a more macro level, the interest rates are obviously still elevated and there is still uncertainty in the market, but it does look like things are starting to clear out, which is great. So then maybe just one more question related to the 2025 experiences, which is which initiatives or strategies kind of had the greatest impact on our investors and our growth throughout 2025?
Yeah, I think, I mean, Chris kind of touched on some of this already, right? Like reestablishing those relationships with our investors, getting in front of them, answering the questions, not hiding our head. That's why we're having these things, right? That's why we still have events. We still have MFIN, which is coming up in a few weeks, right? That's why we get out to a lot of events. We speak at a lot of events. We're not that shop that's trying to avoid the problem. We're the ones that are trying to be part of the solution and solve those. And sometimes it's going to be a messy solution and it's not going to be fun and there's risk involved. But I think that that's one of the things that I'm happy about, what we did on the IR side, the investor relations side. I think operationally, again, we touched on this before, making sure that you double down on your team. It's really, really important, especially when the market's not going to give you that support of cap rate compression, that you're able to extract every dollar out of these investment opportunities you can. And the only way you can do that is with tight operations, right? Buying right and tightly operating it. And so I think we doubled down again on our property management company, which me and Feras have doubled down on since inception in 2020. Each year we continue to double down on it, and dump every amount of dollars that we make on that business back into the business to get the right people in place.
Yeah. Yeah. And I think you hit the nail on the head. In-person events, allowing face-to-face relationships and kind of tying that ship that you're referring to really, Ferris touched on it previously, which is that brought a new president of our management company. He's got an institutional pedigree and he has been running a tight ship and things have been looking better over there. Obviously, it's going to take time to turn around any big ship, but glad to see kind of the progress he's been making in the short time that he's been with us. So with that, then let's move on to talk about 2026 and what we expect to come going forward. So firstly, let's ask what are the key priorities and the focus areas for Disrupt Equity in 2026?
Yeah, I mean, and Ferris, you can add to this too, but I think ultimately it's continuing to double down, right? Operationally, what systems, what processes, what team members do we need to execute at a very, very high level, right? And then we're going to continue to invest in that part of our business, in an effort to enable the growth that we're seeing, right? We are starting to uncover some really, really good opportunities on the buy side. And so to enable that growth, obviously you need the team to do that. And so I think, this year is still going to be a little bit of, price discovery, a little bit of understanding where the market is, but probably going to land in the fives. And your expenses flat, right? We know that we're starting to see rent growth in certain pockets. The point of all that is now you know what the new world looks like, right? And so we're starting to see that coupled with good buy opportunities. Now we feel like it's been de-risked in a lot of ways, right? There's not this uncertainty in the market in terms of the macro situations, and the partnership is fractured, or the capital stack is all jinked up, and they just can't make money in the way that it is, and so they're willing to give it at a discount. And so, all of that said is we're kind of setting all of this up for buying opportunities. I think we'll be net buyers in 2026. And I think, again, 26, 27, 28 are probably going to be the best years of this decade to buy multifamily, because you're going to be up, you're going to be riding the wave back up. I don't know, Ferris, anything else
No,
you
I
want
mean,
to add to
I think
that?
there's two big areas, right? Like Ben said, there's operational, continuing to maintain and push the existing portfolio. The other side of it is we think it is starting. I mean, we're starting to see some really good buys. I mean, I had two of them today that I was actually looking over, right? Where sellers are getting motivated, having to make an exit. And on the buy side, right, it's a good time to buy. And so the other focus is really identifying those opportunities and more importantly, getting investors excited about them, right? Again, it's exactly the phrase that we've all heard, which is you want to buy when there's blood in the streets, right? And there is a lot of distress happening in the market right now. And so that turns into some of the attractive buying opportunities. And, for us specifically, right, we're focusing more on kind of basis, right, on 90s new and newer product. And so really looking at stuff that we can pick up where it's maybe 90s, 2000 vintage, still needs some capital injected to improve the assets, right, which is kind of the value add play that we've done historically. But at the same time, right, we're buying those deals maybe 100, 115, 120, $130 a foot, right? Versus those same deals we're transacting for $180 a foot, 3 years ago. So,
Yeah, and to kind of pick up on that, Ben mentioned doubling down. I think we should double down on our investor relationships, reaching out, having those conversations about existing deals. If there's a concern, if there's a question about what we're doing, I want to have that open line of communication with investors. And also, we're looking to grow. We want to make a lot of deals this year, so we want to double down on those relationships and have our existing investors come in and grow with us as well.
Okay. So this kind of ties into what you guys maybe touched on a little bit, which is just on a more macro level, where do you actually see the market heading for this year? And maybe what are the trends in the multifamily real estate space that investors really should be aware of?
Yeah, I mean, I think we've kind of touched on some of this, right? We're starting to see some level of rent growth. Let's take a step back. The macro view is that you have a supply and demand problem, right? The last couple of years you had too much supply, right? So then rent started kind of going down. But now all of those new developments have already been delivered or are going to be delivered in the first half of this year. And so you're going to have this demand constraint, right? Because you still have a lot of people moving to Texas and the Sun Belt, but now it's almost fallen, the supply's fallen off a cliff. So now you're going to have some rent growth that you can play into, right? The other big fundamental that is still in play for multifamily is that people need a place to live, right? There's a 4 million unit gap in terms of what is actually needed versus what we have right now, right? So eventually that supply is going to spin back up, but that's not for a few years. These projects are multi-year, identifying a land, getting the plans done, and actually bringing them to market. And right now, you're going to have probably a 2 or 3 year lull of new supply coming online. That's going to allow us to increase rents, right? And all the while, now you have a more stable interest rate environment. You have a more stable inflationary environment over those next few years, and you're really going to be able to capitalize on all of these macro dynamics that are happening in multifamily. So I'm bullish on obviously I'm a multifamily guy, but I'm bullish on it for the next 20 years because we just don't have enough of it, right? And I'm investing in high growth markets, high population and job growth markets. Then I think, in the places like Texas and Georgia and Florida, that's what you're going to continue to see, right? So that hasn't changed. The only thing that we're now seeing, which I would say is a positive, is you're starting to see some level of rent growth, which is what we've not had over the last couple of years. I think that, coupled with your expenses and your interest payments gone through the roof, has really made some of the deals challenging. So, Ferris, anything else you want to add to that?
no, I think you hit all the key points. So it's going to be an interesting year to see kind of where things end up shaking out. And maybe I'll
Great.
add, because I think the sentiment, because I was at NMHC last year, right? And the sentiment was that, hey, this is, 2025, that is, was going to be the year that some of this stuff gets unjammed, right? And that really didn't happen in 2025. It started happening kind of towards the tail end of 25. And I think 2026 is the year where a lot of that starts to come to fruition, right? A lot of that 3-year floating rate debt is coming to maturity. They are having to do something with it, whether that be a refinance, an exit, or something else. And so I think, to Ben's point, this is the year you start to see the transaction pick up. And I think NMHC is happening next week, so we're going to get another pulse here very soon. So,
Yeah.
For
Yeah, there's
those on the
always a lot of
call,
there's always a lot of hopium that's being smoked there. So I take it a little bit with a grain of salt, but I think that there's been enough time to let some of this stuff marinate through the system of money that is. And there is a fair amount of cottage industry that's trying to will this into existence. But I think a lot of people were waiting. It should have probably happened last year, but then you had the new administration come in, tariffs, certain things that people weren't really, going to understand or be able to price into investments. But now that we kind of know what that looks like too, I think that again de-risks those commercial real estate investments. I really, and the other thing that we're not really touching on that we really need to be pounding home because a lot of people just don't realize it is 100% bonus depreciation's back, right? Because of the big beautiful bill. And I think one of the huge reasons why I love investing in commercial real estate is because of that bonus depreciation. So that all got reestablished this last year. And so, as an investor, you can take that into consideration whenever you're looking at investment opportunities too.
great. Now, bringing that down from the 10,000-foot view of the macro economy, let's talk about district equity specifically, right? So, how is district equity planning to position itself in 2026 in order to thrive in both favorable and potentially challenging market conditions that we may anticipate this year?
Yeah,
I
I
mean,
mean, I think.
go ahead,
Go ahead
Ben.
first. No, you go ahead.
I was going to say, I think it's what we said earlier, right? I mean, continue to focus on operations, right? Continue to really cement broker relationships so that we can get first look at deals, right? And be one of the first people to, decide on, hey, do we think there's an opportunity here or not? And then the third part of that, obviously, is continuing to nurture the relationships with equity, right? Because again, we need equity to get just as excited about these deals as we are, right? And so, those three things is the recipe of actually completing a successful transaction.
Yeah.
All
Yeah, I
right.
mean, just to kind of piggyback on that, I think, Ferris hit it right on the head, right? I mean, you've got the market sentiment, is still negative kind of coming into this new year, in terms of multifamily that is. But I think it's in a lot of ways, some of it's unfounded too, because the fundamentals are still there. So you need to get new equity excited about it. We're doubling down on that effort again, getting in front of people, establishing those communication channels even more robustly than we've already had in the past. But yeah, I mean, I think we are in a unique position in the market because we've gotten ahead of a lot of this stuff. Yeah, and I'm not here to, say everything's sunshine and roses. Obviously, we've had our challenges too, but it's all about how you handle those challenges. And I think a lot of our quote unquote competitors from the past are no longer even in the business, let alone buying deals. And so I think that culling of the herd, so to speak, is ultimately going to equate to a couple good things. Now we don't have as much competition, so therefore prices aren't going to get bid up either, right? So you're going to be buying them at a more of a true cap or a true basis versus this FOMO that was happening in 21 and 22, which was really kind of, not establishing the true market value of these properties. And I think that's also what we're going to get the benefit of. You buy it here, and then now you can ride up the FOMO. So I think that's the reason why we're really, really excited about the next few years.
Great. And then one last question, I guess. And then we can kind of open it up for Q&A. And for everyone on the call, please, if you have questions, please submit them in the Q&A box of the Zoom window. Last question I'll ask is just, what advice would you give investors who are looking to maximize returns in today's market?
Yeah, I mean, that's a good question. I mean, I would say diversification, is one key, but I mean, you're backing the jockey, not the horse. Yeah, I mean, everybody's had challenges in our business, and anybody that tells you otherwise is lying to you, right? It's all about how you handle that. So, like, what I've learned as an LP on my side too is I'm asking the questions of, hey, tell me about your worst deal and how you handled that, right? How did you communicate? How frequently did you communicate? What ended up happening? What did you do to try to right the ship, right? And so I always give new investors coming in the market, ask those tough questions up front. I mean, at the end of the day, if somebody says, "Oh, well, all my deals are great and they've always performed and they've always been according to projections," they're lying. right? I'm just going to be honest with you. And this is coming from somebody that's a pretty big LP too. And so if you don't, ask those tough questions, expect that you're going to be let down in a lot of ways too, right? So new investors coming in the market, ask those tough questions because you're backing the jockey, not the horse, right? And then invest smartly, right? Invest in high growth markets. Texas and the Sun Belt is still good. Don't worry about what CNN and Fox News says, right? There is still a fair amount of job growth happening, which drives population growth. And then you're still in tax friendly, landlord friendly, and business friendly states in Texas, Georgia, and Florida. Those are the markets that you want to invest in. Doesn't matter if you come alongside us or not. I'm telling you to at least look at those. And there's a few other ones here, but that's what we're focused on. Those are the ones that you're going to be most successful because you're going to have tailwinds. Don't invest in a market that might have a lot of headwinds and you're just hoping for the best, right? Well, I can get it at a 10 cap, or it's the guy told me it's a really, really good basis. There's a reason why it's like that, right? And so you invest in markets that you're going to have some momentum in, and that's going to obviously help, in those times where things might be going off track a little bit.
Yeah, and to jump in here, I would say diversification, and also, like Ben said, you need to bet on the jockey, not the horse. You want to get someone with a proven track record that communicates, that is there to answer the tough questions when there are challenges. And yeah, that's it for me.
Great. And then I'll just add to that what it sounds like you're saying is that yes, the fundamentals, of course, are important. They're still important. They always will be important. The numbers got to be good there. The purchase price has to make sense. But then one thing I'll add to that too is that investors ought to look for a good story, not one that's just crafted to sound good, but just something that actually legitimately supports the story as to why any sponsor believes that the returns they're projecting are going to be achievable and realistic in nature. So that's always something important, but I think it only becomes more significant now as we go kind of back on the rise up from a distressed kind of time frame in the industry. So great, guys. Thanks for that. So with that, let's go ahead and open it up to the audience for any questions that you may have. Um, as a reminder again for anyone on the call, go ahead and type your questions in the Q&A or the chat window, and we will get to them.
All right. And I think I see some questions that are deal specific around, just, when are we increasing distributions on different deals? I mean, please, reach out directly for those. I think for the goal for today is really talking about just, the market and what's going on. So I think
Yeah,
I'll,
more.
I'll take the first one, which is really, do you anticipate preferred equity in the capital stack of new deals, right? And for those that don't know, preferred equity, it's a tool, right? And what it is basically is think about it as almost another set of, it's almost like debt that sits after the senior, but before the rest of the LPs. And, it's about using the right tool for the right job, right? What preferred equity allows you to do is get much higher returns on the existing equity because the preferred equity usually wants a very fixed, well-defined amount. Anything above that, preferred equity doesn't participate. It goes all to the LPs. And so it allows you to get a higher return. Now, the trade-off is it introduces risk to investors, right? And so right now, because prices have come down so much, preferred equity is starting to make more sense than it did historically, right? You are able to basically go into a deal, your basis is already good, that if you layer in a little bit more preferred equity, right, it doesn't really introduce too much risk to the deals, but it allows basically the remaining equity needed from investors to be a smaller amount and therefore give a higher tranche of equity. And so, the answer, at least for me, is it depends, right? It's very much case by case, but it is something that, we do explore on deals, especially in this environment, right? I mean, historically, our first 20 deals, we didn't do preferred equity, right? Pricing didn't make sense, but now it's a lot more attractive.
Great. Next question that's on the queue is really how have the fundamentals changed in terms of projected IRR and equity multiples in the current environment versus in prior years?
Yeah, I think, IRRs have gone up, right? Because right now you have less investors. So a couple things have happened, right? Valuation has gone down, right? A property 30 years ago is worth less today than it was 30 years ago. And at the same time, right, a lot of investors don't have additional equity that was being recycled. A lot of people, were making a lot of exits in 2020, 21, 22, right? Well, that equity is no longer available to redeploy. And so there's less equity in the market. And for that equity, right? investors are looking for a higher return. But because values have come down, it's you can achieve it. And so I'd say IRR has gone up probably about 2 points, I think, is in terms of deals we're looking for today versus what we may have been looking for about 3 years ago. And again, just from a basis perspective, it's much better too, right? Which kind of leads to just longer holds that are in a better secure position, higher cash flow, and allows us to figure out, okay, when do we make an exit and what equity multiples do we kind of strive for?
Great. Okay. Next question is what kind of cap rates are going on these days in Dallas and Austin for the multifamily asset class?
Yeah, good question. I mean, I'd say it really depends on the asset itself. And what you're seeing is that on newer product, valuations have not come down as much, but on BC product, it has. And so newer product, you can still find it in the four caps. Now, some of that in Dallas would have been maybe high threes at one point, right? So that has softened a little bit. But where the spread has widened is actually on kind of 70s, 80s product, where that stuff right now, again, very market specific, but you'll see that trading kind of north of a six cap, right? In place, not even on pro forma and future kind of expectations.
Great. Then maybe the last question, not last question, but next question is rather, what are the terms that we're seeing these days from on financing from lenders? Things like what sort of down payments, rates, terms, et cetera, are we seeing these days, and how has that really changed from historical kind of data?
Yeah, and I can hop in here. And sorry, folks, my laptop crashed on me, so I'm on my phone here. But I think I mean, down payments are still they're wanting a little bit more of a down payment, So instead of like getting up to 75% leverage, which we've never really done, most of our stuff's between 55 and 65, you're probably in that 60 to 70% range in terms of the loan amount that you can get. But right now, you can lock in rates. It's really a function of where the 10-year and the 5-year treasury is, right? Is how you can establish what a lot of these fixed rate products are going to be. And right now, when you add in a spread that Fannie and Freddie need to make on top of it, you're still in the fives. And so, maybe low sixes on certain products, but and that's fixed for 5 to 10 years, folks. So you now kind of have what I would consider not a more nominal interest rate in comparison to the artificially low one as it was 3 or 4 years ago, or the very, very high one a couple years ago. And so I think this is where things are going to land, like I had mentioned earlier in the thing or early in the webinar. And so, if you can make the deal work at 5.5 fixed for 10 years, then you underwrite accordingly. I think the only other difference that I'm seeing on the lending side is there a lot more. They're wanting more additional skin in the game, right? Which is we already invest in all of our deals anyway. But there was people out there that were taking big fees and weren't putting any money into the deal. So Fannie and Freddie are saying no more of that. We want at least some amount of skin in the game, and again, it's negotiable depending on the asset and the experience level of the sponsor. But they're not allowing those types of deals to happen anymore, and I think that's actually good for the market. So that's really probably the only differences. And so you're 60 to 70% leverage, 5 to 6% rate.
Great. Another question is this one I think you have probably a lot of color to add on based on our experiences, but it basically has to do with how we look at investments in a market from a county by county level, right? Do we take into consideration the differences from county to county in terms of regulations and other variables that may be pertinent, and maybe talk about some of our experience there, which I know we have a ton of in this game.
I was gonna immediately, when I heard that question, I was gonna mention Atlanta. So the Atlanta MSA is made up of 20 something counties. And trust me, not all counties are created equal. And so we've had some challenges in certain counties that, were overregulated, there was a lot of bureaucracy, there was a lot of corruption. And especially during the COVID times when you're waiting on rental relief as a landlord, there was just no support of the landlord community there in those counties. So I would no longer invest there. It would have to be an extremely well priced deal for me to price in the risk of reinvesting in those counties, and so that matters. And then the only other thing that I'd also say is county by county matters in terms of property tax valuations. Then to give you an example, kind of more closer to home here in Houston, Harris County is going to be a lot more aggressive with tax valuations and collecting that tax base than say in Montgomery County or Fort Bend County, which are adjacent to Harris County, and those are smaller communities. And so I think that matters. I think people should look at that, and there's plenty of information online as to how landlord friendly they are, how aggressive they might be on property tax valuations, and I think those things are important when you're fighting your tax dollars or you're fighting your tax valuation, and maybe you have to do some evictions as part of your business plan. Take that into consideration. If you invest in a market that takes 6 months to evict somebody, and you have to evict half of the property to execute on your business plan, you can imagine how long that's all going to take. So I think county by county is absolutely something somebody should be taking into consideration.
Yeah, it plays a big factor into our investment decisions and how we look at things. And frankly, it is if probably best to say that it's a core fundamental reason as to the starting point of what we look at before we even decide, are we willing to consider an asset in that location in the first place? And if we are, which is going to be a rare exception, it has to be a killer deal with exceptional terms for it to be even something worth considering. So great question. And then maybe one question that we have is how do you see costs of new construction costs these days in our present market as compared to 2 years ago? So really more on the new development side of things.
Yeah, I mean, it's certainly come down. I mean, everything kind of wanes and ebbs and flows along with inflation. So I think 22 and 23 were kind of that really high,
Peak.
inflationary environment, which obviously that's going to translate into material costs and labor costs and all those things. So, we've seen a reduction of probably anywhere from 20 to 40% on materials, right? And so that's going to go straight to the bottom line. So I think your construction cost as a comparison to 2023 is going to be 20 to 40% cheaper. And that's not all markets. There's going to be certain markets that are going to be a little bit more expensive. Again, we have the luxury of being here in Texas where labor is a little bit cheaper. But those all kind of hit your bottom line, and so that might spur eventually some additional new development. But I think people are also weighing that plus the cost of capital and where are rents, because they really try to pencil in where's the rent's going to be, in 2 to 3 years, and does it make sense to actually do a new development right now? And once you start seeing that rent growth, that will be really the starting gun that the developers are going to need for them to go out and actually start moving dirt and constructing new things.
Great. Well, I think that was the last question that we have. Any deal specific questions, we encourage you to reach out to us directly, and we would have to kind of give you information or address those kind of questions that are more on a asset by asset basis versus kind of more of a macro look. So with that, I want to take a moment to, first of all, thank everybody for joining us and take a second to actually tell everyone about how they can engage with us and Disrupt Equity as we move into the new year of 2026. So firstly, if you are looking for any sort of investment returns and so on, investment opportunities, of course, we always have deals going through our pipeline and that we have live, even several right now. So we encourage you to visit our website at disruptequity.com/invest, where you can see our deals and, of course, reach out to us directly at invest@disruptequity.com. And myself or Chris or someone on the team will make sure to kind of get you the information you need, have a conversation, and make sure that you can assess whether or not an opportunity is something that makes sense for your situation. And beyond that, Feras kind of touched on this a little bit earlier. We do have our conference that we do, of course, each year. And this next one is taking place on February 7th. So in about 2 weeks or so, right here in Houston, which is where we're headquartered. So we encourage you to visit the website, www.mfinvestornetwork.com, to check it out, purchase your ticket, and we'd love to see you in person, face to face. So unless anyone else has any other comments, then we definitely appreciate everyone's time. Thank you for joining us for another Investor Power Hour, and we look forward to having you joining us next month. Keep an eye out for your emails, and we'll be sure to share the information as that time gets a little closer as well. Thanks, everybody, and have a great, happy new year. 2026, make a successful one.
Thank you.
All right, thank
Thanks,
you.
everybody. Bye bye.